All right, today I want to talk about a fallacy that I call the all-in, all-out fallacy. And this is a trap for a lot of individual investors, especially individual investors as they develop a level of sophistication where they start to learn about different types of, I guess I'd call them secondary risks of stocks. So a novice investor may not know about these things to be worried about in the first place, but a more advanced investor might understand, okay, we're running very high fiscal deficits, so there's a risk. We're running very high money printing, so maybe there's a risk of inflation. And you start to understand a little bit more about the geopolitical implications of whatever's going on in the world. You might start to understand maybe political risk domestically. And as you start to learn about these risks, you get concerned about them naturally, and so you have a temptation to react to those concerns. The fallacy lies in thinking that you can make an all-in decision or an all-out decision based on some concern, even if that concern is, in your mind, very justifiable. So I'm going to go over a couple of examples in this video. And the best example we got was when Trump was elected in his first term in 2016. We have a number of friends who sold all their stocks because Trump. And again, totally reasonable on some level, but if you look at the scoreboard, in other words, you look at the performance of stocks since his election or over the course of his presidency, the scoreboard says you're wrong, even though the reasons seem very compelling at the time. So this is the central problem. You might have a very compelling argument for something, but the stock market traffics in the future and in the world of the unknown. And so this is where we get back to epistemic humility. You have to be humble and have to consider that a decision can be wrong. And I'll give you an even more extreme example. Back in 2013, I had a very lengthy discussion with a friend of mine who at the time was extremely nervous about inflation risk and interest rate risk. He was very upset about all the money printing that our central bank, that the Fed was doing in response to the great financial crisis in 2008, 2009. And by 2013, he couldn't take it anymore. And he emailed me to tell me that he was selling all of his stocks, 100% of his stocks. And obviously, to do that in 2013, it's a terrible decision because of the upside that you forego by being all out of the stock market. So the central idea, the central message I want to convey in this video is don't make all out or all in decisions. There is nothing wrong with having a view of the stock market, whether you're bullish or bearish. That's fine. But you want to be humble about what your actions are, and you always want to leave some stocks in your investment portfolio because you might be wrong. So, for example, a better decision in that case would be to have a very compelling argument and to think it through, sure, but to sell maybe a portion of your stocks or, not all of your stocks, basically. The problem comes from making the all-in or all-out decision. And that is epistemically arrogant, and you can really get hammered when that happens. So just keep that in mind. Stay humble. It's okay to think through a market view, but don't make a 100% reaction to it. Don't sell everything because of whatever your concerns are, and don't put all your money into the stock market because you're bullish about something. Consider the fact that you could be wrong. As always, thanks for watching, and I hope you find these videos helpful.